Imagine waking up one day and your favorite trading instrument, be it the Nifty Expiry or the Sensex Expiry or the Bank Nifty Expiry, the very tool many of you rely for your daily income and strategy is suddenly gone, like there is no zero to hero strategy or anything. So what would you do? I mean, we are talking about the reports and already the whispers which are going around, like the SEBI is clamping down on weekly options. The question is, what would happen if SEBI implements? So welcome back to the channel. This is Trade Smart with Mohiith Shankar. So today we would dive deep into arguably the most talked about and potentially disruptive regulatory move in the Indian stock market. This isn't just any regulatory jargon, it's something that could fundamentally change the way we trade, how brokers operate, and even the liquidity of our markets. So in this video, I'll be trying to break down, I would be breaking down what exactly SEBI proposing and why, the immediate long-term as well as the short-term effects on the individual traders like you and me, and how this potentially could shake up the brokerage houses and the overall ecosystem of trading in India. And finally, we will try to understand the million-dollar question: is it ultimately good or bad for the Indian financial markets? So stick around and watch till the end so that we can make an informed decision regarding our everyday day-to-day trading. First, let us understand the core issue. Now, why the SEBI has floated the consultation paper and it has asked the feedback from all the stakeholders. Now, who are the stakeholders? Stakeholders are like retail traders like you and me. It might be institutional traders, fund houses like the mutual fund houses, and domestic DIIs, FIIs, everyone, and along with the brokers. So there was a consultation from everyone regarding this, whether they should be stopping or why are they doing it. Now first understand the core issue. One has been that the traders have been losing money. At least 90% of the traders who are dealing with F&O have been losing money. In fact, the last year, I think they put the number as 1.05 lakh crore lost in F&O trading. Why? Because they don't have the knowledge. The retail traders lose money in F&O and weekly expiry. Because of the weekly expiry, they see it as a big gambling option. Now, why are they considering it like a gambling? Because you might have seen, if you open the YouTube channel and see, there are many zero to hero strategies. So one thing is that they are taking high leverage or high risk. For example, they promise you in fact, I do get many calls nowadays. They say that invest 50,000 and they make about 2 lakh in one day. So the unrealistic expectation, short-term speculation, and lack of knowledge. They don't have a proper risk management in place. No knowledge can be attributed to the core cause of this move by SEBI. Most of them treat the expiry days as gambling, all in, all out. For example, either they make it zero, for example, the zero to hero strategy, what we listen from most of the even YouTubers as well. So don't fall into the trap of zero to hero. Either you put 50 rupees, you make it zero, or you make it exit with 200 or 300, whatever be it the case. So this is the gambling mindset which has finally forced the SEBI to take action. Now SEBI has made many has put in many rules and regulations in the past. For example, increasing the margin amount required and shifting all the expiry, juggling all the expiry dates. Everything has been done, but now this would mean a death blow to most of them, especially the brokers, because they might lose the main chunk of the brokerage. They might have to rethink about their business. So what happens to us now? We are mostly interested. What I would be talking is mostly interested for us as a retail trader. How would this affect? So we need to be prepared. What if SEBI actually comes up with this? Now what would happen is, one is, fine, it would reduce the losses and everything, and would be less liquidity in the market, because there will be only one monthly expiry date. For example, now you have weekly expiry options. What happens in case of a monthly expiry? You might say, okay, fine, then it's okay. We would only wait for monthly expiry and then we would trade. But there is a catch in this. For example, now if you are weekly, now imagine that the market is at around 25,200 and you want to buy the call option at 25,200. Now you might get it for 50 or 100 rupees depending upon the time needed for the expiry of that particular option. Now, what happens if the same 25,200, if it were to be monthly option, instead of 50 rupees, you might have to shell out 500 rupees per lot. It would be the price, not per lot as well. 500 rupees, 10 times more. So what would indirectly mean is that if you can't trade with less capital, you need 10 times of whatever you are having now. So this is definitely going to be a huge negative for most of the retail traders like you and me. For example, you have imagine for Nifty 50, 500 into 75, you calculate this, how much it might come up to? 37,500. Okay, instead of 500, instead of 50 into 75, 3,700, 500, you need 10 times more the money whatever you have been using now. So all your strategies, for example, the risk management, everything needs to be reset again. So this is a huge disadvantage for us, especially for the retail traders. Now what would happen is, but we can also say that end of the day it would be good for the Indian market, but it's arguable. I personally feel that this is bad for the market because the liquidity decreases. If the liquidity decreases, okay fine, you have a predictable nature of the market, okay fine, you know that, okay fine, the markets are moving like this, there is not much volatility or liquidity attributed to the weekly expiry options. Now they have been changed into monthly, okay fine, less headache, less stress. But what are the chances of you making money on your investment? That would drastically reduce. It's as simple as you need 10 times more the money to make the same profit what you are making today. For example, if you are making 5%, it would probably be 0.05%. Now, would you be even wanting to take that risk to enter into this market? I doubt so. Right. Now, what is the other thing which we need to consider is that now most of the traders might migrate from a SEBI regulated entity like an exchanges to an unregulated trading. Unregulated trading, be it dabba trading or any other form of unregulated trading, which is not regulated by SEBI. Now, SEBI can't put checks on everything. And if unregulated trading increases, it's again a headache for SEBI. Right? Now, what happens to the brokerage houses? Okay, fine. They would have to rethink about their brokerage business. Their income would drastically reduce. Even in case of fund houses, the churning would be less. And for example, what about the hedging? Hedging, the cost would increase. For most of them, say suppose there is an election result which is coming in next week, you can't hedge because you have to take a monthly expiry option. You can't hedge your positions what you are already holding in, or any other news for that matter. The hedging cost increases. The spread between the bid and ask increases. The buying, what I mean, if you are getting something at 200 rupees and you have to sell it for 205, the bid and ask itself becomes 5 rupees. I'm just giving an example, not exactly, it may not be exactly this amount. The bid and ask spread will increase, the hedging cost will increase overall. This is a negative even for the research analysts like SEBI Registered Research Analyst or the fund houses, the advisories, the advisory services as well as mutual fund houses. It is negative. What about the other? I mean, in fact, it is negative even to the big players as well in the market. Now, this is of my opinion. I might be incorrect. Now, SEBI, in order to protect the investors, and there is a trade-off between market efficiency and then investor protection. Now, what do you think is the most effective way of increasing investor protection? According to me, I think it's education and have a certain minimum qualification which should be required by any trader who wants to enter into F&O. The broker has to check their certifications and then probably like something like an NISM. Now, would everyone be able to do NISM? I doubt so. How many people will do an NISM certification to just enter into an F&O? So the liquidity, anyways, even in that case, liquidity drastically reduces. Right? Now, finally, the verdict, according to me, it's bad. It's bad, and you can write into SEBI. You can voice your opinion. Probably this is the right time you need to voice in your opinion to SEBI and tell them what are the events. And if you are writing any negatives about this move, you should always also give the solution to whatever you are thinking about this. So to summarize, is it good or is it bad? And I think when we see the positives and the negatives. It is largely bad. This is my opinion. If you differ from my opinion, do put that in the comment section below. It removes a crucial and a flexible capital efficient tool which is needed for hedging and strategy implementation. This becomes very costly. It increases the barrier for entry even for a small trader. They can't participate in the derivative market. You need capital, a big capital at least, to enter into the F&O trading. With this impacts the livelihood of professional traders as well as the revenue of the brokerages firm. So it decreases the market liquidity as well as the innovation. So what do you need to do? Ban? Do you think it is necessary for investor protection and or an overreach that stifles the legitimate trading? Let me know in the comments below. If you have watched this video till now, thank you for your time, and do consider subscribing to the channel if you find it useful. Thank you.